welcome back to the next episode of Can I Be a Stock Market Genius? I keep forgetting what I've called the series. I think we're on episode 5 now. This will be episode 5. So we're starting to get through them. I don't feel like I've got any better at it yet, but it is what it is. Time will tell if it gets better. Time will tell if people view it. So what I'm going to do is I'm going to go through G3, which is what we came across at the end of the last video, which looked quite exciting on the quick take spreadsheet here. Good return on capitals on EBIT and on simple free cash flow. And this here looks pretty good, doesn't it? That you can purchase a company within 3 to 4 years on their earnings alone at the moment. So felt like it was definitely worth a deep dive on that. It doesn't appear like they've got too much debt either, actually. Only $1 billion in revenue, $1 billion in enterprise and $3 billion in revenues. So quite interesting, growing revenues as well. Let's get the big spreadsheet up, the main spreadsheet. Have I got it in here? Yes, I have. I left it in here from the last video. So first off, let's actually, before I get the spreadsheet up, trying to get into a rhythm of doing it in a specific order, so it's easier to follow. Not only that, it puts me into a rhythm when doing it, so I don't want to, if I can, be jumping around all over the place. We want to understand the business model, how it operates, where the revenues come from, if there's a breakdown in revenue segments. This is all from my checklist. Locations as well, what the risks to the company are, if there's been any forward guidance. So generally where I start with that, move the paper out of the way if you can hear that flapping. Generally where I start with that is on ChatGPT. You can find all this stuff in their own documentation, but I found that if you put it in a ChatGPT, the question, most of the time it'll give you a reasonably detailed response, than give you links to where they got their sources from. So I'm reasonably comfortable using ChatGPT now. If there's anything that I don't understand, then I'm going to have to deep dive into the company documentation. But let's start off. What is the business model for G3, how you spell apparel? EL, yeah. How does it make money? What are the revenue breakdowns? See what they come back with. So core operations, design, source, distribute. It designs and markets apparel, accessories, and own licensed and private label brands. They don't manufacture in-house. Instead, they contract independent producers, predominantly in Vietnam, China, and Indonesia. Okay, so cheap labor, wholesale department stores, specialty retailers, mass merchants, run stores, e-commerce. Okay, revenue systems breakdown. Total sales 3 billion, up from the year before. Vast majority of sales are wholesale operations. Retail operations is still up though. Not a lot, is it? It's not significant in the scheme of things. Revenue by brand, own brands. I don't know why they've got a line through that. 51% net sales. Major names include DKNY, Karl Lagerfeld, I don't know. Licensed brands, about 1/3 of sales. Calvin Klein and Tommy Hilfiger licenses phased out end of 2023, previously made up roughly half of the company's license revenue. So we were just looking at EVH in the previous video, which owns Calvin Klein and Tommy Hilfiger. So they've lost a licensed seller there then in this G3 apparel, is in that they've either chosen to phase them out or 2023 as well, which is interesting because that's the year that they were not doing very well. on their on the spreadsheet on their financial data. That's the year they had some big losses. Okay, not saying that this has anything to do with it, but proportionally it's going to be something to do with it. Some online sales are embedded in wholesale and retail reporting and not shown as separate. Okay, profitability snapshot: 1.3 billion, 40.8% gross margin, wholesale gross margin 39.4%, retail gross margin 50%. Margin lift is attributed to higher contribution from owner brands, no royalty cost improvement mix. Yeah, okay. For available modelling data, this is a model then, is it? It's not, yeah. Fiscal year 2023 estimates. Owner brands carry higher margins since licensed product require royalty payments to third-party brand owners. Yes. PVH, there you go, for Calvin Klein, Tommy Hilfiger. So obviously that's probably why they've got rid of it. They want higher margin income. Licensing strategy: historically big with Calvin Klein and Tommy Hilfiger licenses, driving 50% of revenue but low margin. These have been phased out in fiscal year 2025, shifting toward more own brands where profit retention is higher. DKNY stores plus digital sales. Okay. Wholesale scale partnerships with major retailers like Macy's, Nordstrom, Costco. Okay. Sports licensing contribute heavily. Okay. Revenue comes primarily from wholesale operations, 97% of sales. Wow. With own brands increasing share, 51% of revenue. 3% of total revenues will generate more higher gross margin from the retail operations. Profits are improving thanks to shift towards ownership of brands and a scaling back of 2 margin license arrangements. The only thing I guess you got to worry about there is fashion is very fickle. You're a big deal and then you're not a big deal for quite a long time. So if you're risking that when you have a smaller amount of brand names under your, if you've got licenseship of an owner of a brand that's currently very popular, at least you're making money from it. If you're making all your own stuff and then all of a sudden your brands aren't very popular, you're going to take quite a hit on that. And that happens in fashion all the time, doesn't it? You know, not that I'm a fashion expert, I'm an engineer, but people are very fickle in that sort of industry of what they want to wear, what they don't want to wear. And as soon as someone says, oh no, that doesn't look very good, jump out of it, don't they? Costs include manufacturing, marketing, logistics, store operations, license, royalty fees with own brands, lowering royalty burden. Okay. No idea what TLDR means. G3 makes money designing, sourcing, and selling apparel under a mix of own brands, higher margin, licensed brands, lower margin. Historically, it leaned heavily on focused licensed names like Calvin Klein, Tommy Hilfiger, but now it's pivoting towards own brands like DKNY and Karl Lagerfeld, which now represent the majority of revenue and bring better margins. Wholesale distribution is its dominant channel, while company-run retail and e-commerce play a small but more profitable role. Yeah, go on, dive into that. Would you like me to dive into SG&A trends, licensing and earning brands, or how retail digital companies compare? Yes. Ooh, yes. What I'm going to do while that's doing that is get the balance sheet up. Let's have a look, see what they're carrying, because they're going to be, well, they're not carrying a lot of debt, are they? Because the enterprise value's only a little bit higher than market value. Don't pay a dividend. Purchasing back some stock, not on the level that PVH were purchasing back stock. Gross margins 40.3%, SG&A margin 30%. So as their costs have gone up over the last few years, I think it's probably a trend you're going to see in basically every industry. What's caused this here, though, is the interesting thing. Simple free cash flow margins just gone boom through the roof and staying that way. Now they, could very well be legitimate, or are they accounting things differently? It's below book value, just above tangible book value. interest coverage ratio. Wow. I mean, if they've got no debt, then yeah, I can, 21.5 times. Right. Balance sheet. Before we get into the cash side of things, try and keep it in some sort of methodical way of doing every single stock, so we know what we're going to do. Accounts payable 200. Is this? I take it it's in thousands. Yeah. Is it? Hang on. Yeah. Right. I checked that 3 times and moving the bloody thing too fast. Liabilities, current portion notes payable, so they do have notes. Not a lot left though. They must have paid off loads. Where does that come from? At some point, what am I looking there? Yeah, at some point they've almost ridded themselves of debt by the look of it. What was debt in previous years then? That was 2024, so it was only 1 year ago. Balance sheet. Total debt. I don't know how that's gone negative. Doesn't make a lot of sense, that does it, have a negative debt? Unless that's just gone into the system wrong. Short-term debt of 61 million. Right, we're gonna have to look at this, aren't we? Because again, it could be how they're accounting for debt. I am on G3 here. Short-term debt of 61 million, and what are they saying here? Not even 61 million on there. Current portions and notes payable. I'm going to guess that that's the debt. Yeah, all right. We might have to change that because that doesn't look correct, does it, on the data? Current operating lease liability. So we want their notes payable, net of discount and amortized issuance costs. Only 6 million. So they've done something huge there. Allowance for doubtful accounts. That's got to be something you've got to look into as well on this sort of thing. Leases, notes payable, long-term debt. Company had previously completed a private debt offering of 400 million aggregate principal amount of the senior secured notes due August 2025. In 2024, the company used cash on hand and borrowings from its revolving credit facility to make a 400 million payment to voluntarily redeem the entire 400 million principal amount of notes at redemption price equal to 100% of the principal amount of the notes plus accrued and unpaid interest. I don't know how much cash they use from that. And then did they break that down? It might be interesting to look into that. At the date of redemption, the company had unamortized debt issuances of 1.6 million associated with the notes. These debt issuances costs were fully extinguished and charged to interest expense in the company's results of operations. Wow, so they paid off their debt. How? They said use cash and the revolving credit facility. How much cash did they have before? Oh, they've lost a significant amount of cash. So, yeah, 250 million in cash is gone. So did they put 150 million on the revolving credit facility? Right. That's interesting then, because that means that the debt on the data has to be wrong. Let's go on Yahoo Finance and see what they're saying the debt is. G3. Balance sheet. Quarterly expand all. Right. Long liabilities, current liabilities, current debt and capital. So that's got the lease in there. interesting is are the leases being counted in long-term debt and capital? Long-term debt is only 6. Are they counting the capital leases as debt? What am I doing? Wrong one. What are we saying that is? Current debt. Oh, bugger. Current debt 11,959. Wrong one. Short-term debt. Yeah, they're taking it from there. 11,599, wasn't it? 11,599. Let's have a look. 959. Where am I going? $959. Long-term debt. So they are. Problem is that they're going to be counting that all the way along. Or are they? 406 million. They obviously didn't count it there. Wrong one. I want this. Long-term debt 6783. 123. Right. I tell you what I am going to do, right, because I don't know the answer to this. 6783. 123. So our total debt has to be graphic calculator. 1159. Oh no, I got that one wrong again. 115959 plus 6783 equals 100. I've done there then. Put one thing in there, shouldn't be in there. There we go. 18,742 in the total debt. Total debt. 18,742. 123. They're gonna have the same. It's gonna be the same issue in there, then, aren't they? They're counting the capital leases into the debt. Now, I don't know how that references, to be honest. So, what I'm going to do, I'm going to ask, how do capital leases compare to, what would you call it? Conventional bank debt or bond? I spelled conventional wrong, have I? Debt. Why? No, I did wrong there. For the purpose of enterprise. What do we know? Joel Greenblatt. We know Joel Greenblatt does. Joel Green. Oh, come on. I don't know why I wanted to look grammatically correct. ChatGPT should be able to figure it out. Joel Greenblatt states he uses short and long-term debt for enterprise value. How do capital leases fit into this? Right. Okay. We know. I don't know if you know that, but I know that. Capital leases. Leases of ownership characteristics. Borrowed funds from banks or bondholders now treated like debt under explicit liability. Interest expense, yes. Depreciation, yes. Assets capitalized, no, unless related to finance. Cash flow impact, fixed payment split into interest and principal, same as a bond. Ownership, assets usually end up with ownership. Debt may be secured or unsecured. Debt like obligation, traditional debt. Capital leases in EV calculation. Capital leases should be included in enterprise valuation. Okay. In modern accounting, capital finance leases are interest bearing, so they are included in this version of debt. But beware, Greenblatt explicitly excludes operating leases, which were previously off balance sheet. So any lease not capitalized doesn't enter his EV calculation. Okay, so why would he exclude it? Greenblatt style in practice. EBIT is used because it includes depreciation, is close to true operating income. Yeah, okay. Would you like a spreadsheet? Why would Greenblatt, not that this is actually reading his mind, but why would Greenblatt exclude it when you're stating it is exactly like traditional debt? Greenblatt does not exclude capital leases. He does, or at least did historically exclude operating leases, and that's where the nuance lies. Right, okay. Do they split out their capital leases? So obviously their long-term debt is gone. Effectively, it's almost gone. Leases. Operating. Do they even have capital leases? They must do, because they're on... they're broken down in the balance sheet. Current portion of operating lease. No, they don't even mention capital leases. Nothing. So they don't even mention that they've got capital leases. Leases, retail stores, warehouse, distribution centres, office space. Leases of initial term of 12 months or less are not recorded on the balance sheet. Most leases are for a term of 1 to 10 years. Some leases include one or more options to renew. Operating leases. So why would Yahoo Finance say, take us straight back down to here. Why would Yahoo Finance say that they've got capital leases when in their documentation they don't? Current capital lease obligation 4968. Are they 4968? What have we got here? 4968 current operating lease. So they're confusing operating lease with a capital lease. Interesting. So that means you can 26922. In my thinking, you can take that. You can remove that from the debt. Yes, all right, it's very real, but like we've said before, an operating lease, if you get rid of a place, I don't believe that you're obliged to keep paying. If you cease to lease a property, are you still on the hook for the remaining operating lease? On hook for the remaining payments under operating lease, even if you cease to use or vacate the property. Hang on a minute. Right. Why do Roaring Kitty? I started typing, sorry, before I press re-record again. Why do Roaring Kitty and Michael Burry, because they've both openly stated this, believe that an operating lease is not a debt to be counted towards total debt if you are still on the hook for the operating lease payment once closing said store. I mean, they could sublease, I guess. The key understanding is the economic philosophy versus account reality that investors might bury and adopt. Let's unpack why they and other deep value investors might not treat operating leases as debt in valuation, even though the company is still obligated to pay. So from a business operator's perspective, Burry and others draw a distinction between debt, funds you borrow to invest in control assets, rent operating leases, ongoing access to service or space you don't own and can walk away from strategically even at a cost. They're saying operating leases are operating choices, not capital structures. Burry put it this way: I only count obligations that can't flex with operational decisions. If the store doesn't work and I close it, that's not like bond debt. It doesn't bankrupt the company. This is true. So even if there's a contractual obligation to pay, the economic flexibility of an operating lease is greater than actual debt. Right, downside is limited versus traditional debt. He saw many of them expire and soon renegotiable, countable, making them low risk operational liabilities, not true financial risk. Agreed. This is where I stand. Accounting versus cash flow reality. Under book a lease liability, but it's not interest-bearing debt. The cash flows are spread out and non-discretionary, yes, but also attached to operating scale, not financing. Spurry-style thinkers argue, if I close this store, yes, I owe something, but that's a business cost, not a debt problem. Yeah, you could sublease it, or just negotiate and try and worm your way out of it, which cannot be missed without legal default. The contrast with a bond payment, so bonds can't be missed. They focus on free cash flow, not gap debt. In those frameworks, operating leases don't impair solvency unless you wildly overexpand. Yes. What matters is cash flexibility, renegotiability. Well, is that even a word? Renegotiability and store level profitability. Operating leases aren't real debt to Burry and Roaring Kitty because they're tied to business operations, not capital structure. You often have flexibility to exit via sublease negotiation or closure. Yes. They don't trigger bankruptcy like traditional debt, gap treatment, economic risk. They say if I can kill the lease when it stops making money, it's not the same as owing 50 million to bondholders I can't negotiate with. Agreed. Would you like a comparison of two identical companies, one with leases, one with debt, and how that pays out in EV, EBIT? Okay, yeah, show us that. This is a learning video, going off on a bit of a tangent here, but 900 million lease liability, 1 billion in debt, 100 stores, all lease, 100 stores, all owned, 0 up front, but rent 1 million a year, 10 million per store, financed with debt. 10-year operating leases, 10-year debt term, 100 million lease expense, 100 million interest plus depreciation, can close stores, negotiate lease, owns assets, can't exit debt. Right. 200 million from operations before lease or interest, depreciation of 50 million only for company B. Tax rate. Company A leased stores. Net income 75 million. Let's get down to the crux of what they would be. Net income 75 million. So they're the same. Cash flow is 125, but the cash flow is different. Yes, now the cash flow would be different, wouldn't it? Because of depreciation. Right, sorry, I got interrupted again then. Yeah, the cash flow would be different because the depreciation would be added back in because you've already made that payment. So it's just because of the amortization portion of it. So the company debt is obviously worse with the leases because that payment's already been made. Or 900 million gap, is it? Am I right in saying that? Debt for enterprise value is 0 because you've got leases. Because of that, yeah, okay. Hang on then. So it looks, no, I'm wrong. It's the other way around. It's 700 million EV, 175, yes, because you've got the debt. Right, okay. The cash flow is better, but the enterprise value is worse. Yeah. Sorry. I did know that. I was just reading it like a doofus. Even though GAAP says both have obligations, company A has optionality. It can exit leases if it stores underperform. Company B is locked into the debt. Yes, defaulting is legal reputational consequences. Yeah. Company A's cash flows are more flexible, and in distress scenarios, it can adapt faster. They can say if the business shrinks, company A can shrink costs. Company B is chained to its balance sheet. Yes. From a pure debt adjusted valuation perspective, GAAP EV includes lease liabilities, so both companies look similar on paper, but Greenblatt style EV excludes operating lease liabilities as they're flexible, treating them like rent, not fixed financial debt. Yes, that's how I feel about it. I believe that's how I feel about it. That's the camp that I've basically fallen into from the research on this sort of thing. Okay, anyway, where were we? We were back at the fact that they've buggered off a lot of their debt. What's the price of this? 23. So it's got, you know, half of that's in current assets. So, you know, liquid. Right. So how many times EBIT is it trading then? We've already looked at this, haven't we? Where are we? Down here. Sorry, I've gone too far. 2.8 times EBIT on enterprise value. So in less than 3 years, it could pay itself back. Do you know what? I don't know why I've done this, because this is not exactly the same figures. These multiples. Literally only just realised this. I said this is why you shouldn't listen to anything I say, because these are all the same. I bet if I go back through all my other videos, these figures are all the same. So, what an idiot. There we go, see? Learning in real time that you're an idiot. Anyway, okay, so that can end up being removed, and I can just explain this in the notes. Can't I? Right. Right, I'm back. That was another interruption, a Lego-related interruption. So, yeah, so we just figured out that I was an idiot. Interesting. Right. Okay. This company does it very interesting, doesn't it? The balance sheet looks good. Interest coverage of 21 times because they've basically got no interest anymore that requires payments. So what I've done up here is I want to figure out what the book value is without the operating lease. So what I do here is I get I'm just going to do this off screen, but what I'll do, I will get the current and non-current operating lease. I lost my calculator. There's my calculator. Current operating, non-current operating. So 49687 plus 220235, and then I will put that in here, and this will remove the leverage of the operating lease from the book value, just so I can see how that would affect the book value. TTM book value is $44 without the operating lease. So I believe that's significantly different. It would take the net up to $18 as well. And then a price to book of half then. 0.5, is that right? I can't remember. Basically, all I want to do here is it just takes the operating, I have to manually do it, but it takes the operating lease side out of it for reasons we've just seen. There's flexibility around operating leases. Is it proper debt? A lot of people disagree. We've just learned about that just then. So what is the normal book value for okay, so it's a little bit better, $6 a share better without the operating leases. Still changes the picture slightly, doesn't it? You know. So cash flows. I said I like the return on capital. It looks pretty good. They've had a better history of return on capital than PVH as well, haven't they? Because PVH had one red year, and then because this is all green all the way through. Simple free cash flow 685 share. So I do want to see what's increased this over the 3 years. Free cash flow, because it got significantly better all of a sudden. Because the net income's the same, see? Did they change the way they work their working capital? Yes. So the working capital changed, the way they look after it. Let's have a look on the balance sheet. Inventories. I mean, they're not particularly different. Receivables, not particularly different. Interesting. So it's got to be on the payables then, is it? Not particularly different either. And yet on the cash flow side of things, the change in working capital that was always historically negative. Now they're running positive. Okay. .com's pretty big, isn't it? I don't really like that, but Can ChatGPT tell us what's changed in their change in working capital? Is it? Close that one. Going back to G33. Their free cash flow has changed dramatically in the last 2 years. It appears to working capital changes. What has changed? They're saying they get less free cash flow from 2023, more than halved. Significant increases in accounts receivable. Okay, so is my data wrong again? More than half. 2023. Did it? It didn't. What's Yahoo Finance saying on that? Cash flow. Go to annual just so we can. Free cash flow. Oh, they're saying it more than halved. Is my data wrong then? Operating cash flow 587, 582. Where's my mouse gone? Stuck on a different screen. 587, 582. Is this wrong? What quarter are we on? Q1. Is my data wrong? Are we in that territory? What was the net cash from operating activities according? This is a problem though, because bear in mind I'm doing trailing 12 months, whereas that was annual. Where would that be? 1 year, 2 years, 21, sum 86. What's the sum on there? 86, okay. Is it purely because of where it is at in the TTM cycle? All right, so I had to go away and look at the data, check it to see its veracity was good. So I did find a few things wrong with it. Nothing overly major. I think the main confusion came from the fact that I was trying to compare TTM, which was out by a quarter. I knew this at the same time. I don't know why it still confused me, but it was out by a quarter with annual statements on Yahoo's finance. So obviously, it was never going to line up correctly, especially if you've had wildly different quarters, which has happened a few times with this company in recent times. So that's where the majority of the problem came from. Like I said, there was a few issues with the data. I went through, several recent quarters just to make sure. There was a couple bits that I had to change. Green just indicates that I went through it and checked it. I did check that one as well, even though it's not green, but there we go. So the only issue is that there's been about 5 days since I started that video, and I can't really remember what was said on it. I've been to work in the meantime, and when I go to work, I take a laptop with me. So on my lunch break, I still have a little peruse through and see what I can come up with. And so I have actually in that time finished my analysis on G3, and I've wrote a little bit about it in my tracker. So what I'll do to finish this video off is I will just go through it, tell you what I found and what I believe to potentially happen in the future, because I do not take any of this seriously, because I don't really know what I'm doing at all. But yeah, so I will tell you what I've done, and we can go with that. So on the this is the last 10K that they released. Now they're talking about how they were going to lose the PVH Corp licenses. So obviously that's going to have a significant impact on their revenues. It says here the sale of the licensed products is an important part of the business. Net sales under the Calvin Klein Tommy Hilfiger brands constituted about 34% of our net sales in 2025 and 41% of our net sales in 2024. So they have revenues of 3.1 billion. So that's a significant portion. It's just over $1 billion in sales that they're going to lose. Now, it says a bit further down here that we experienced 188.4 million decrease in net sales of Calvin Klein licensed products. So that's compared to this time last year, but which were more than offset by a 254.4 million increase in net sales of DKNY, Donald Karen and Karl Lagerfeld products, which are the products that they own themselves. That's their companies. So yes, they're going to lose $1 billion in sales, but it's sort of been offset by 254 million in increase in their own products. So conservatively, you're looking at a shortfall of about 800 million. Now if you were to be conservative and say, well, going forwards, that might not continue. So maybe they've only grown their own products by 50%. It's 900 million. You're still around about $1 billion short. It is good, though, that they are growing their own products. It also says here, I think it's here, we also recognize higher gross profit percentages on sales of products under our own brands, which makes sense because they'll obviously don't have to pay license fees or anything else like that. They don't have to buy them and then sell them. They pay to manufacture them and then they sell them. So after the payment of manufacture, everything else is pure profit. So yes, they're losing a significant portion of their earnings, but it's also good that they are growing their own products, which have the higher profit margins. So to add on top of that, it also says here, we also seek to expand sales in our go-forward portfolio of licensed brands, including Team Sports, as well as for our recent licenses for Nautica, Halston, and Champion brands that launched in 2025, and Converse and BG brands. I don't know what BCBG is, but Converse I've heard of. Obviously, it's quite a big make. It's not as big as Calvin Klein or Tommy Hilfiger. People buy shoes far less often than they go out and buy pants and and t-shirts and shirts and all that. But it is a slightly mitigating factor. Like I said, the losing Calvin Klein and Tommy Hilfiger is huge, but it's lower margin stuff if they are going to grow their brands, their own brands. It will be combated a little bit with taking on a brand as big as Converse. So it's not the end of the world, but we've got to be conservative in our analysis going forwards. So what I have done is, I don't know if this is actually accurate at all, or if it's even the done thing to do. But the way I have looked at it is that I've effectively said that that billion is gone. That's not revenue that they're going to make back. So on the simple free cash flow side of it, of what they currently have of, where is it, down here, 686 a share TTM in current simple free cash flow, the way that I calculate it, which is there in that note. Pause it if you want to look at it and see. So if we were to say that that's gone, 34% of it's gone. Now, obviously that's the revenues. When it comes down to simple free cash flow, it's slightly different, especially if they're losing lower margin stuff and increasing higher margin stuff. Obviously, that's actually probably a bit more beneficial to the free cash flow. But on a conservative basis, I've said that they've lost that free cash flow. Now, if you were to lose 34% of that simple free cash flow, or 35%, 6.86 times so 6.86 times 0.65, you're still looking at around 440 a share in simple free cash flow. That is on the assumption that they've completely lost all revenues from the PVH Corp licenses going, and that they're effectively not growing their own anymore, and that Converse hasn't really kicked in. You're still looking at around $4.40 per simple free cash flow under that line of thinking. Well, obviously at $23.92 a share, 23.92 divided by 440, it's 5.5 times. It's currently trading at about 5.5 times simple free cash flow. Now, if you were to go down here and see what it was historically, this is where it starts to get a bit difficult, because it's wildly all over the place. Look, it traded at some very high multiples. Now, in recent years, it's traded at very low multiples. Now, whether or not that's because people have been a bit worried about the licenses, whether or not they're going to lose them, possibly. I don't really know. But say we were to say that 440 was, trading at 8 to 10 times, all right, historically, because it's very difficult to take an average when it was so high previously and now it's so low. But the one thing they've got in their favor is that they've basically reduced all debt. So their long-term debt is effectively gone. So you can use a higher multiple, according to Joel Greenblatts' books, providing the debt is lower. So if you were to use 8 to 10 multiple on 440, then 4.4 times 8, you're potentially looking at $35 a stock, up to $40 a stock. Now, under that line of thinking, I feel like that's reasonably conservative. I have wrote about it in my tracker. Let me just pull it up here. So yeah, 680 goes to $4.50 a share, pounds, because I'm in England. Let's say it's difficult to get a historic average, as it's all over the place, but 8 to 10 times multiple seems reasonable. So 450 times 8, 4.5 times 8, let's just check that it's correct, it's $36. So that's taken in a reasonably conservative, I believe, that's gone. You're going to lose all of PVH. It's not coming back. You're not going to grow your own, even though they've stated that they already have. You're ignoring the fact that the margins get better on their own stuff as opposed to the licensed stuff, and you're ignoring the fact that they've got new licensed brands. At $4.50, I changed the the figures and ran it through, you're still looking at around 19-20% return on capital, which isn't too bad. Now, one other thing that I noticed, right, from a technical standpoint that I found quite interesting, you might not, but from a technical analysis standpoint, is that they were buying in on the 18th of June at around 21.33. Now, if we look at the chart, the 18th of June is around here during this week and around 21.33. Well, look at that. On that trend line, I found that interesting, right? I'm a fundamental investor, pure and simple, but I do think there's a bit more to this technical analysis than everyone thinks. And who was it? EVP and the director possibly thought so too. Look, because that is exactly where they bought on this ascending trend line. I just thought that was reasonably interesting. Now, I don't know what I'm doing, okay? I really don't know what I'm doing. This is absolutely does not constitute any investment advice. Do not listen to me. There's a lot of waffle in this video earlier on, but I'm just telling you that, during my lunch breaks, this is what the conclusion that I looked at and came to. Now, if you were to say $36 is maybe the upside, on the chart as well, that takes you right into this range of where it was peaking out before. So since 2019, the price has peaked out here several times. That takes you right into that value range. From current prices, about 40% upside. So, it's very difficult. Do not take anything I say as gospel. I'm just telling you my line of thinking. If you were to listen to Monish Prabhai and you were to listen to Lilu, this is not enough upside. Okay, if you want to have the multi-baggers and the returns that they do, 40%, it isn't enough, and it is very lumpy. In that you are making a lot of assumptions. They are losing a lot of revenue. Not only are they losing a lot of revenue, they're losing very big brands. So if they were selling Calvin Klein or Tommy Hilfiger in their own shops, people could be going to their shops specifically just to buy their product, the Tommy Hilfiger and Calvin Klein products. Now, whilst they were in there, they may also have kind of stumbled across some of the DKNY stuff and thought, oh, okay, well, I'll buy that at the same time. But they've gone there specifically for Calvin Klein. They've gone there specifically for Calvin Klein or for Tommy Hilfiger. Now, if that was the case and they've happened to buy DKNY because they happen to be in there, well, that's footfall that's now lost, so it's lumpy. If they no longer sell Calvin Klein and people are, I'm only going to buy Calvin Klein or Tommy Hilfiger, I might buy some DKNY stuff if I stumble into the store. That's footfall that's lost. So it's very difficult, but yeah, I quite liked Merck, and I didn't really understand. I couldn't buy it because I couldn't understand why people were willing to overlook the debt. Now, G3, I quite like this as well, but there's a lot of potential turmoil coming in this company with the loss of those revenues. Nobody really knows how the new brands are going to go down, and if you want the good value investor long-term returns, I feel like you need to be looking at higher than 40% return. I don't really know, I don't really know what I'm doing. I'm just literally explaining my way of thinking. So do not copy anything that I have said. Do not take it as gospel. It means nothing. Absolutely do not invest on my advice. But this is what I saw on my lunch breaks, and it'd be interesting to know if anybody watches this what they believe about it as well. As I said, I'm probably not going to invest in it. I'm not confident enough in my analysis skills yet, and I'm not experienced enough to turn around and say, yeah, I quite like that. So I finished my analysis. I showed you that I've now told you that I finished my analysis, and I'm going to leave it at that. Please, 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 please do not invest on anything I say. I do not know what I'm doing. I'm not an investor. I'm not a financial advisor. I'm literally just a man who is blogging his journey to try and become a successful investor. So as there's been several days in between this, I'm going to leave this video here. That is my line of thinking, and please, if anybody does watch this, talk to me what you think. Tell me that I'm wrong. Please tell me that I'm wrong. And that will do. Thank you very much, and like and subscribe, and I will see you in the next video once I've spliced these two major portions together and figured out what I'm doing. All right, thank you very much. Goodbye.